Welcome, everybody. This is Daniel Diaz, your host, and welcome to another Sound Money Matters feature presentation. Today is February 6th, a week after what some people are dubbing Black Friday with the crash of gold and silver. And the last few interviews I've done, I've had Keith Weiner on last week. We had Rob Keentz on. We were focusing more on what was going on, the fundamentals, explanations from Kevin Walsh being appointed as the next Fed chair. And the reason for that is he is an inflation hawk, which is interesting. It's the opposite of what Trump has been saying. Kevin Walsh kind of spooked the markets, and there's something called efficient market theory, where they factor in the future of the markets, and that was reflected. And then that sell-off triggered a bunch of margin calls, which is what Keith Weiner was mentioning on our interview last week. And then Rob also got into more of the fundamentals with how many options contracts there are and his belief that this was probably coordinated. But we're going to move away from the fundamentals today, and we're going to bring on our guest, who is one of the best technical analysts on the precious metal space, Patrick Karim. Patrick, welcome.
Hey, Daniel. I wouldn't say the best there. I'm just, doing the charts.
One of the best.
Oh, you said, okay. Yeah. Well, look, yeah, it's always just always trying to stay, objective, unbiased. And it's very hard because, when people are making money, the last thing they want to hear is me being less bullish, telling people, hold on, guys, look, we're stretched from the moving averages. There's no low risk entry. And sometimes it upsets people the wrong way because they construe. If I'm less bullish, sometimes if somebody's uber bullish and they own a lot of that whatever asset, silver or gold, they construe that as me being bearish. But how it works in chart trading, guys, you have a base, you're agnostic in a base. You don't know a base. Sometimes people, they think, oh, it has to break to the upside, I'm bullish. No, it's a base is a base. It's distribution or accumulation. You don't know yet, right? Because if that base falls apart to the downside, then what you were looking at was distribution. If that base breaks out to the upside, then what you had there was accumulation. You don't know. But once you get a breakout, you're not agnostic anymore. That's when you're bullish. But then after that, when you start reaching measure move targets, or you're stretched from the moving average, you're not as bullish as you were at the beginning. People sometimes they think because the price went up and it's at all-time highs, whatever, that's when you're supposed to be most bullish. But no, you're supposed to be most bullish when nobody's talking about it, when you're just breaking out. That's when you should be the most bullish, right? But people, they don't look at the charts there. They don't know that that's the most time to be bullish. They're only aware of the instrument once their neighbor talks to them about how much money they made, that their waiter, their Uber driver, their taxi driver, whoever. And then, they get the FOMO. And then when I tell people, look, we're super stretched, there's no low risk entries, people, they think, well, Patrick, you're bearish. No, I'm telling you, we're still in nut trend. It's still long-term bullish. I'm just telling you that entry right now is not equivalent to the entry we had back in 2024 or early 2024 for silver, or late 2023 for gold. It's just time's moved on. We're not at that place anymore. So where are we today, right? Where are we today in all of this? I'll show you a chart. Okay, I'll show you this one, guys. I don't want to scare everybody. I put this one on Twitter. Essentially on the left, I want you guys to focus on the left-hand chart. On the left is the 1980s run. So it had a run here in the 70s. This is daily chart. Run up, then it went sideways for a few years. And after that, it exploded upward. And here the bottom pane, guys, what I have is the distance, not the distance, the candle change. So how much did we drop in one day? This is what this bottom pane is telling you. And I'm going to zoom in there on what actually happened. So here you had the run up. sideways move, run up, and then you had the blow off top breakdown here. So you had a rising support line. And here, that first drop here, that was 25% drop. Bam. 25% drop back in 1980, rising support line. And that's it. You broke that rising support line. You're in correction mode. Some people might have thought this thing would have broken out to the upside eventually. You just don't know. I'll show you what happened today, guys. Silver, nice run up, similar to the 1970s run up consolidation. And then after that, we had a rising support line here. And bam, huge drop here out of that rising support line. And look, what's the drop? 26%. 1% more than the huge drop that we had back in 1980s. And that run up, guys, was kind of similar. It was a 41 day run up from breakout to peak, 118% gain. Here was a 37-day run up, 195% gain. So kind of the same logarithmic, blow off top. I'll put into quotes there on this time frame. And then we just had a total failure of that once again. And this is the box. I'm drawing a box here because I don't know what's going to happen here, right? Until this resolves, right? Because remember here, look, you had 80s, you had a bear market rally here or a little echo bubble, I would say. Then it faltered, echo bubble. Then it carved out some type of descending breakdown line. Man, I don't even have that yet. I don't even know how low that's going to go before I even get some type of bottoming. Eventually, there'll be, I'll show you guys just like, eventually there'll be some type of, we'll see a bottom, a bear flag. But if the bear flag doesn't fall, then after that, you get another shot of glory, right? There will be another continuation pattern to the upside. But we're not even there yet. We're not even there yet. It's right now super dangerous. There's landmines everywhere. We have crazy up days, crazy down days. You see, after that here, we had an up day of 10%. Then a couple of days later, we had a down day of what was that, 20%. And then we're having maybe another up day here, 8% so far. Like, this is not the time to be a hero and say, look, this is it's going to rocket upwards right now. And of course, everything has to be nuanced by what type of trader you are, what time frame, right? Daily charts like this is good for day traders, swing traders. Maybe they might go on the weekly chart. Investors, position traders, and stackers, stackers don't even care about charts.
Yeah.
But let's say you're a long-term investor for silver, then I'll put on the monthly chart just to show you guys. Let's just focus on let's just put it here, monthly chart. There you go. So monthly chart, you're goodness. Well, yeah, nothing's broken yet, right? Nothing's broken yet on the monthly chart. So here you have that rising support line, but now we accelerated. And look, this is the problem I have. Peak volume. There's a whole bunch of big warning signs here. Distance of the price from the 36-month moving average. That's the red line. Look how stretched we are. That is crazy stretch. I'll put a horizontal ray. We are above 2011 levels. We're at 1974 levels, where after it broke that rising support line here, look, it went sideways for a couple of years. It healed. It let the moving average catch up. We're somewhere up here. So now that's why I've been telling people that the time to go long, guys, was back here at $24. And now, if you're a long-term investor and you went in at $24, look, you don't care too much so far, right? You have a lot of leeway, but anybody that got in at 60, 70, 80, man, they're with huge drops like that, that scares the bejesus out of you, right? So that's not good. But what I don't like is this peak volume here, this huge volume. With hindsight, we'll know if that was euphoria. And maybe, some people who have, who sell coins and stuff like that, they might see peak volume here, but you also see peak volume when there's peak price, right? This is when everybody's interested. But this, in conjuncture with the price being super stretched, if it falls apart here, see here, we had peak volume back in the 2011. Here you had some peak volume right there, 2008, right before it crashed. And sometimes you have peak volume at the bottoms. Here, peak volume 2020. Remember silver squeeze? There's peak volume, and sometimes you have peak
Yeah.
volume at the bottom. But peak volume, if the price here loses this rising support line there, man, it's getting close. I didn't know we were that close. If we lose that, that means we're in a more important correction mode for silver. So then we're going to have some resistance here at $85. And then we're just going to have to wait and see. There will be a pattern here, a play zone, I like to call. Let me put my, if we close below here, there will be a play zone. I don't know how big it is going to be, guys. But there will be this play zone where price is probably going to go sideways here. Will it go down like this, like that? You don't do anything when price is doing that, right? You have to wait until it resolves. And once it resolves, like here in the GFC here, it went up, broke down, went sideways, down. Then you get back in once it breaks out. So we just don't know yet. It's just not safe. Remember, huge base here. That's created the launch, the move upwards. Here you had another one. You know, these huge bases there, that's the ones that create these crazy moves. And there's no base now. This is you're hanging in midair there by the magic of the uptrend. So still in that trend, guys. No issues, still in that trend. There's no low risk entries. And yeah, if the daily does not recuperate immediately, then eventually we're probably going to see the monthly start entering correction mode. Did the weekly enter correction mode? Ugh, yeah, that's ugly. That's ugly. Because look at that, guys. Here, rising momentum, peak. I'll show you how crazy the FOMO was in silver. Look at that. I'm stretching out. This is how stretched we were on the weekly from the 36-week moving average. The last time we were that stretched, it was 1902. More recent history was in the 1980 blow off top. That's the only single time we were that stretched from the moving average. That crazy peak volume, that's not a good sign. If it's associated with, look at that, it's failing here. Yeah, 100% correction mode on the weekly chart. Even this crazy 8% bounce, for me, it's nothing. The momentum's still unwinding. That means the price is trying to heal. It's trying to let that red line catch up there. So whatever it does here, I'll show you what the red line is going to do. You know, that's a correction, right? A correction is time and or price, and you want to let that moving average catch up. But why be a hero here? You just don't know how it's going to play out, right? Is it going to keep falling more? Is that going to be just a beautiful bull flag? But if it plays out like that at this length, that's kind of we're in March now, so there's no need to try to catch any type of bottom. For me, just you let the market do what it's have to do. Let that reset. That's a big warning sign that this went too strong, too hard, and yeah, that's the nature of the beast. There, it's going to trap a whole bunch of people, and until these people are cleaned out, anybody who bought at 120, because that's a whatever 110, 115, 100, these people are now resistance, right? Because now the price went down below their entry point. Psychologically, what they're going to want to do is they're going to want to break even, right? They're going to, as soon as they say, oh my goodness, I'm back at my price, I don't have to tell my wife I lost any money, I'm out, So that's why it's hard. Once you have these hard drops, it's hard to overcome that, to do a V shape. You could have V shapes, people always pray and hope for V shape. It's fine, but you need some time there to clean out all the people who bought that peak euphoria there.
Yeah. So two things I want to comment on. For those who are stackers and they're dollar cost averaging, that the stackers, they don't care about these moves. That when it comes to the precious metals space, it's about discipline and patience. And you set a plan where you're going to buy X amount of dollars worth of silver or X amount of silver or gold every time frame. Let me get rid of that. Hold on. You get rid of every time frame. So you say every paycheck, every 2 weeks, every week, every month, I'm going to buy X amount of dollars or X amount of ounces. And it doesn't matter, because if the price is 121, you bought it there, but now it's at 70. You're dollar cost averaging your buy-ins. So I just want to encourage the most powerful investment method, in my opinion, is dollar cost averaging, because you catch the highs and the lows, and you're always averaging out your cost basis on your metals. The second thing I would like to bring up is you just gave everybody a mini heart attack about the short term outlook of silver. Can you talk a little bit about the long term market, because we're in a bull market, we're in a capital rotation event? Talk a little bit about that and
Yes.
what that means on the long term. That capital rotation events typically last 10 years, and we're 2-3 years into this capital rotation event. It was actually confirmed in December of last year. So maybe give some people a little bit of hope about the future of gold and silver versus just the little heart attack you gave them about them buying at 120, 110.
Yeah. Yes. Sorry. It's that's the. I'll show you the yearly chart for silver, and check this out. So this is remove the drawings, remove indicators. Yeah, that's the yearly chart. So the yearly chart for silver, it had a confirmed breakout this year. Right, on this candle, guys, we had a confirmed breakout of this huge 50-year, 45-year pattern. But it's kind of bittersweet, because this is the problem. Here you have two targets. Here you have the cup, and here you have the handle. Silver is so explosive in its move that the measured move for the handle has already been reached. Bam, you're done.
Mm-hmm.
So you can't. So on that breakout, on that confirmed breakout, you can't front run a breakout. Ideally, I would have loved to have just a short candle here and close 2025 at $43, and that would have created a better opportunity for people. I can't. Sometimes the charts, when you get the breakouts, they're just beautiful. Sometimes they just huge candles like that. You can't do anything about it. So that move's reached, and it kind of explains also some of the resistance we're having right now, because what a measured move is essentially is the energy in a pattern on the way down. It's getting held below, and once you break out, that energy that went in explodes to the upside. And very often you'll get these measured moves there, and once you reach them, see here, went up, sideways move, and the explosion here, the bear flag, you'll reach it. Sometimes you overshoot it. Here we overshot it. Now the sellers are coming in. We're just in February, guys. These are yearly candles. I don't know where the candle's going to close, right? We could have a correction here, it goes down. By the year, it could close where it is now, could close higher. Now, this big target, that's the hope. This is the hope that's left for everybody in silver, right? Anybody who bought at 120, that's your hope there, 275. So this huge move here is kind of baking in that classical measured move target of 275. Now, when is it going to happen? Like a couple of years? Sometimes see here, these moves went sideways for 1-2 years before starting to go back upwards, right? Could go sideways for a couple of years here. I don't know. And then after that, you go upwards. People, look, if you're a long-term investor, don't seek instant gratification. You should not even be on Twitter. You should not even be on X. You should not be on social media. You should not even be looking at the daily chart. If you're a stacker, you should not look at any charts, because it's weird. Sometimes, Daniel, some people on Twitter, oh yeah, I know some stackers, and they do look at price. Well, I'm sorry. If you look at the price, you're not a stacker. You're just not. You're a hybrid, maybe. You're a stacker, but you're something else. You're trying to be an efficient stacker, maybe. You want to you're looking at the charts to fine tune as stacker / investor, but you're not a true stacker if you look at the price. In the way I see it, if you're looking at any type of chart, let's say you're looking at a 12-month candle chart. Each of these candles is 12 months. You're an investor. You're simply an investor, a long-term investor in silver. Uptrend, higher lows. Now we did a higher high. But it's just this now. People are, this could even go down here. I don't want to scare people there, but the price could even go, who knows how it was going to go. Could go sideways. Let's say we have a GFC type of event, or, there's a whole range of places where this arrow could go before it rockets upwards. We just don't know yet. But it is in an uptrend. So there's no doubt about it. Look at that. I'll put it on the even on the quarterly. Look above the 12-quarter period moving average. Here's the 6-month chart above the 6 semestrial, the 12 period. So 12 times 6 months. moving average above, look above the 12-year moving average, above the 36-year moving average. Look, it's above stuff, right? So uptrend, fine. It's all about your time frame. But this, if you're looking on the yearly candle chart, you need a 10-year horizon minimum. And yeah, so it's a long-term play, right? Very, very, very long-term play. But you got now, because of all this crazy move up, you have to expect, like even here, GFC there, you had these crazy moves up of these bases, sideways 1, 2 years. And then after that, it started moving upwards. And then it did the other move up, right? So it's practically a repeat here. There's some type of correction here, consolidation that's going to happen. Could last a year. I don't know. We'll see how that plays out. But this is just a brilliant, brilliant reminder for people to look at the charts. Don't buy stuff because you hear somebody talk about it. It's practically too late unless the person you're hearing talk about it is a chart analyst, and they'll get you in on these breakouts where the price is coiled and tight and then not stretched from the moving average. Even here, look, we're getting a little bit stretched there. So it's kind of natural that, go sideways a little bit before going upwards. Even here on the yearly close basis, the only time we've been this stretched, Daniel, was back in the blow-off top. It's not good. You don't want that to be that stretched. You want a slow move up, but that's where we are with silver there. It just did a lot too fast. Even the silver to gold ratio did a huge move down, and obviously the buyers came in, huge wick. I'll go on even on the monthly there. We just have to wait. You have to let the dust settle after a strong move like that. That's the gold silver. So this is useful for stackers who want to maximize their amount of ounces of silver or gold. They're not going to fiat. This is gold price in silver ounces, and here gold price in silver ounces. We went all the way down to 43 there. 43 to 1. That's crazy there.
I had a customer come in yesterday and converted 2 ounces of gold to silver. And I'm like, you are a gold silver ratio guy. He's like, absolutely. I'll be back when it drops below 50 again. I'm like, okay. So that's a stacking mentality too, because for stackers, they don't care about the price. They care about the gold silver ratio and growing their stack, right? That's kind of like the goal. And if you don't want to mess with dollars, that's how you grow your stack, guys. You buy, you have your dollars, you convert it to real money, gold and silver, every pay period, whatever time frame you decide. Then when you want to grow that stack beyond what you can buy with the dollar, you play the gold silver ratio. And just quick for those who don't know, the acronyms, GFC stands for Global Financial Crisis of 2008. And the GSR is gold silver ratio. Now, touch on a little bit, if you could, Patrick, after you show this part of the chart, about the capital rotation event and what that means long term for people.
Just, I'll show you this one. So a better word would be capital rotation process. Because an event, there's many events that trigger the next explosion in gold, silver, commodity prices. So these events is when the stock market takes a tumble in conjuncture with the gold versus stock market ratio breaking out, or in conjuncture with the silver versus the stock market ratio breaking out. This is the Dow Jones priced in silver, or that breaking down, So, but you need these events, these capital rotation events. They need the market. They're instigated by market weakness to the point that whatever they're going to do to save the U.S. equities will fuel even more the commodities on the recovery side. So that's the event. A process is a situation where over a longer period of time, you have multiple capital rotation events. Some are ninja-like, some are the main ones where everybody's aware of. Some they're super capital rotation events. So look at this one here in the 1920s, all the way to 1968. Then we had a bounce, and then we had the break, I think maybe 1972 or 3. We had a super capital rotation event because you had the ratio breaking down here. You had the stock markets rolling over, but at a conjuncture of a 45-year trendline break. And we're having something similar today there. This chart is from December 30th on a quarterly basis, But if I do it, I'm pretty sure that it went down below, but now silver pulled back, and I think we're right at that line here. So this line, 1, 2, 3, if it bounces here, it's going to really be an important line. That once you break down below that, that's an equivalent super capital rotation event within a capital rotation process, right? Where the stock market is not able to do, higher highs. It's rolling over here. That's the market price in the silver, lower lows from here, lower highs. It's already, the process is already underway. We have bull markets in gold, silver, but the super capital rotation event where we get that really huge break, that whatever we saw right now in gold and silver is nothing compared to what they're going to do once they close below that line, right? Like, so now we had like a mini blow off top. It's super scary. It looks like the 1980s one, but in the 1980s, guys, when we had that daily chart, remember that daily chart I showed you guys of look, we were at the end of a super capital rotation event. We were all the way down here, right? Now we're still up here. So if we had like a parabolic melt up on the daily chart, and we would have been running hot for 10 years, then I said, okay, that's probably the end of it there. We're that daily chart, blow off top, falling apart for silver is probably the market telling us after a long run like that, we're done. Now we're having the blow off top right here on support. We're not even like, we're like in 1968. People forget there, but silver ran hard for like 20, 30 years here. Silver ran hard. People don't know this there. I'll show you the chart there.
Yeah.
Silver ran really hot for, look at all these years there. And people, they always look at gold, but silver was free floating back in the remove drawing,
60s.
remove indicators. Look at that. Oh, look at this. Silver, look, people forget silver did this there. It bottomed with US equities down here there. And look at that. It ran up there a lot alongside US equities. And then after that, here it started outperforming US equities. And then after that, it fell apart here. And then after that, it went crazy. So silver's all like, it's running, it's doing the same type of thing that it did back there. So I think sometimes like we're close to here where we're going to have it there. And then after that, we're going to probably have the crazy move up there is right around the corner. But right now we do have some damage to heal on the shorter time frames. And you should hope that it heals now rather than later, because the more it takes time to heal, and let's say it does a V shape and it keeps going up, then I don't like it at all. It's just creating more and more eventual damage that needs to be healed, right? Look at that crazy melt up here. It took a couple of years to heal. Crazy melt up after that, it took a decade to heal. So you gotta be careful what you wish for. Stackers should never wish for silver price to rocket upwards. If they're thinking about that, they're not stackers. Stackers should actually hope the price of silver goes down, because that means a reflation of the US dollar purchasing power for consumers. And that means society's healing as a whole, right? If you're a true stacker, it's not just preparing for the worst, but you should hope for the best, right? You're kind for your friends, or you want your family, the people who don't buy silver, you want them to have a good life. But that means if you want them to have a good life, that means the silver price has to go down, because that means a reflation in purchasing power over long periods of time. So, if you're getting greedy and you think about higher silver price, then you're not a true stacker. You're just out there to convert it to fiat eventually. So, but we're still early. This is like the huge big picture. So right now, in the next couple of years, I don't know how long this is going to last, for the next 6 months, a year. It's, hopefully silver hibernates in an orderly fashion, lets that chart reflate here in favor of US equities, and then bam, then we go for the kill after that, but we're that early there. We're here somewhere. We're not at the end of anything. I don't know how long that's going to last. Could last 5 years, 8 years, 10 years, 12 years. You're just going to have to wait and let it play out. And that's when we get, 10,000 gold, but even more now. I think it's probably going to be 20,000 gold. 800 silver, crude oil, 300, no problem. That's stuff that's down the pipeline. But right now, as of today, when we're talking, we're still at that daily chart there, that scary daily chart there, where we broke, or even the weekly is scary there. where we broke that rising momentum and we're in healing mode.
So that is the good news. We are in a capital rotation procedure. Is what you called it? Process,
and there'll be events along the way. And we probably had a ninja event back in 2022 when the stock market tumbled a little bit. But now the main capital rotation event there, the main one, is on the docks. It's waiting to get activated, and that's when the stock market is going to roll over. That's when it gets activated there.
All right. Awesome. Well, I'm glad that is the forecast for the future. And I do want to comment on something, from what you're showing are the futures contracts, the physical trading markets. But on the physical side, this is what I've noticed. People have slowed down on buying and selling because it's understood. People bought high, they don't want to sell. Stackers, they're just coming and stacking every week. Doesn't matter the price. And then people who are watching the price, the investors, they are waiting to see what happens if it's going to go down. So things have slowed down. But there seems to be a shortage of physical silver from wholesalers, and not just physical silver. Maybe you want to do this too. Copper has been blowing off the shelves. People are buying copper like crazy right now at crazy prices. $5 an ounce. Some people are paying up to $10 an ounce for 1 ounce of copper. But here's what I know. We sold quite a bit of silver yesterday, and I looked at all my wholesalers, and one wholesaler that I use is completely out. They have no silver eagles, no rounds, nothing. And they're a major wholesaler. The other wholesaler, if I were to buy silver today, it would take 1 to 2 weeks for them to even begin delivering it to me. So that's just supply that it's just going to sit there. So there is a shortage right now in the physical silver side. And I can only assume other silver shops, I've been hearing silver shops are running out of silver too. So people bought like crazy during this run up, and the demand was so high that the biggest wholesalers in the country are running low. And then they're transitioning from silver to copper, which I think is fascinating. What are you seeing in the copper charts?
Yes, I'll show you copper. It's copper and silver there. They track pretty much each other there. But right before I show you the copper chart, I just want to show you guys, yes, these are the Shanghai futures. Everybody's talking about the Shanghai futures. That's the candle chart. But the Shanghai futures, guys, and here at the bottom is the Shanghai futures price versus COMEX silver, whatever you want to call it, spot price in the US or around the world, I guess US. But look at this. Whenever Shanghai futures spike, that means they outperform too much. Remember just a couple of weeks ago or even last week, the premium, it's so high on the Shanghai futures. Well, when that premium, it's not about the premium having a premium on the Shanghai futures. It's about when that premium is too high above the COMEX price, guess what happens? Once it reverses, bam, top, sideways move. Look at that, peak FOMO. Shanghai futures prices too much, bam, sideways move. And look at this crazy outperformance. At this point, the Shanghai futures were so much higher than the COMEX, and people said, I have to catch up. Remember that? It was at $130, the Shanghai futures. People say silver has to go catch up. Well, they're catching up now, but to the downside. So now COMEX Shanghai is going down. So it's catching up to COMEX price. They're contracting the difference, but it's happening with both of them in correction mode. And often you see healing process, a sideways move, a multi-year sideways move. I don't know how long that was, a 1 year sideways move here. So when I see that and the daily chart fall apart, it just tells me that there's going to be a healing period here. I don't know how long it's going to take to heal, but there's some healing here that's going to need to be required. So that's the way I see that. I'll show you the copper chart, and let's just do it this way. Poof, copper. So yeah, copper. Look, copper is fine. It's a little, yeah. You had a breakout here. You had a breakout here, but you also had breakout lines here. So essentially, what I'm looking at is the price went sideways for a few years. The moving average is coiled in tight on the monthly chart. And then after that, higher lows, then higher highs, and we are in an uptrend. Here's the distance from that 36-month moving average, the red line. As long as we're above here, it's fine. We're expanding away. We're not super stretched from the moving average. So this is not like silver, where silver, is crazy stretch and falling apart. This thing is just, we're a few months in already there. That's how early we are. It's just, it's just moving up slowly but surely. And there's nothing wrong here so far for copper at all there. It's just, you're kind of seeing what happened with silver. Well, sometimes copper leads, and sometimes copper lags, but right now it's just doing its thing. It's an uptrend. Silver's still an uptrend on the monthly chart, right? It's just that there's damage on the weekly and daily that it needs a breather, and copper doesn't quite need a breather yet. There, it's consolidating a little bit, going sideways. So there's no harm done here. Quarterly chart, how's that look like? Quarterly chart, there's some breakouts. You see here the bottom pane not too stretched from the moving average. As long as you're carving out higher lows, it's all good. Yeah, I'm not a super fan of that wick, but you can't, the quarter's not closed yet, so you got to let it do its thing for now. So there's no, is it falling apart on the daily? I think daily, it's finishing up its correction there. Roof drawings. Yeah, that's not super pretty there. That is not super pretty. Breakout, sellers coming in, and now you're back. It's hanging on the thread here. So yeah, not super. So 100% correction mode. Pull, flag. But was that a blow off top here? I hope not. These measured moves there, you have them all over the place, right? Pull, flag, pull, target reach. Now we have another pull leading that flag. So if it resolves upwards, then it's going to be up here. But now it's like, yeah, it needs to heal there. Yeah, there was I think in harmony, right? Like everything, when silver there went down the drains there, but everything went down the drains, right?
Yeah.
Platinum, palladium, and there's no manipulators there, right? But the price still goes down because it's not really manipulation that carves out this price chart. It's actual macro, fundamentals that going into the metal sector, the metals, right? Gold, silver, copper, platinum, palladium. And when the flows come in, they all get tailwinds, and when the flows leave, they all get headwinds. There's no need there to worry about JP Morgan or anything like that there.
Yeah. Yeah, 100%. So that's good. I just saw that because people weren't able to buy an ounce of silver for $100, they were buying copper, and if it's same thing on like how all the silver wholesalers are lower out of silver, the biggest copper dealers are completely out of copper. So there is in the physical markets, it just sucked up all the product, all the supply out of the physical markets. So let me get rid of that. There we go. So do you find that there is a disconnect between the charts and the physical markets, or do you think there's a much closer correlation between the two?
Well, it comes down to what you trade. I hear that people, the physical, like, what are you talking about here? The physical, is that Shanghai price? Is that the physical for you? Like, can you teach me something about the Shanghai price?
Like buying physical gold and silver, like the actual market, the
actual. Well, look, you could always have a futures contract delivered to your house there. So I don't know. The spot price is the price, right? Because if I buy a futures contract and I wait a month and I don't sell it there, what's going to happen? I'm going to have a delivery, right? So is that metal not going to be there? Are you telling me that I cannot get that? What happens if a futures contract, expires and I ask for delivery? They're going to give it to me, right? They have to.
Right. Well, I mean more like coin shops, JM Bullion, Max, that type of market, physical market.
I don't, I don't go enough in those. The last time I went to buy silver, it was at Kitco in downtown Montreal. I had no issues buying with a small premium. I had no issues buying some silver coins and stuff like that. But Yeah, look, I can't trade. So that's a price. Like the physical market there, like you're describing it, I can't trade that. You know,
Right.
if I'm pushing $1 million worth of stuff, I can't go and make my money at the dealers buying the silver and then trying to sell it at a premium later on. It's not liquid enough, right? I don't like.
Yeah.
So if there's premiums or discounts at the local shop, I can't do anything. Like it's kind of secondary for me. I know a lot of people say, well, I can't get that physical at that price, Patrick, even if spot's there, they don't have it in stock. Well, we're not doing the same thing, me and you there then, because I'm trading spot price and you're talking to me about something else.
Mm-hmm.
And I can't do anything about it there. It's like, let's say I had 300 kilos of silver and I want physical and I want to dump it. Like nobody could take that, right? Who could buy that off me?
Yeah, there are ways to dump it. I mean, there's
at the spot price, at spot or close to spot. Like how much discount are they going to take off there?
Anywhere from $5 to $10 back a spot is what is right now in the current market. Maybe when it wasn't so volatile, it would have been maybe $1 or $2 back a spot. But in today's market, to be $5 to $10 back a spot.
So what is that in percentage? That's like.
Well, it was 5%. It was 5%. Yeah. Well, back then when it was $100, it was a little less than 5 to 10%. So now it's probably closer to 8%, maybe 12%.
Yeah. So that stuff I don't have to deal with, or like anybody who trades, the paper. Like, But again, if you want to make money, you have to trade the paper, right? It's efficient, it's liquid, in and out. But if you're a stacker, then you just buy, and I guess paying 5% premium or discount every 10 years is not the end of the world, right?
And I think there is a correlation between the physical and the paper markets, right? Because if what we're seeing is true, that the wholesalers are out of supply, copper is out of supply, they got to restock that. So they're going to either use contracts to buy and get delivery of that copper or gold and silver. So they're going to be sucking metals out of the COMEX, out of the LBMA. So if the physical markets are drying up, that has to reflect on the paper markets at some point.
Sometimes you see that at tops also, because the paper market could also be forward looking of that rupture and already priced in that whatever is happening now. Who's the chicken? Who's the egg? I remember there was a Peter Brand there. I know a lot of silver stackers that don't like him because whatever, he's all over the place, but he's a brilliant chart trader and he was a commodity trader. I'll have to find his tweet there. And he's a commodity trader for 30, 40 years or 50 years, I think. Like he explained in one tweet, like the argument that everybody who's putting your argument out, the rupture, they'll have to buy. But he put out the counter argument of that, but from the physical standpoint thing. And I said, oh, of course. And I can't believe I can't remember that. Maybe if we pause the interview, I could find it. But essentially, when I read that, I said, okay, that's why I love doing charts, because there's always a narrative or something, a fundamental thing I don't know about that's counter to that. Because if it would be that simple, that it's just that argument that the people, the wholesalers, they have to buy the contracts because they're running out of metal, if that would be the only fundamental moving driver behind it, then price to infinity, like, I don't know. It's like,
I'm not saying it's the only. I'm just saying, do you think there's a disconnect or an actual correlation between the two?
I don't have enough data. I just know that whatever that is, there'll be another thing that I don't know about and another thing I don't know about. And all these things put together, it's the actual price chart.
Yeah.
Because remember Silver Squeeze, it was the same thing. They can't deliver, the planes are not delivering in time stuff. It was crazy. Like the bullish fundamentals news we were hearing, it was like silver was unstoppable. And guess what? That was the exact peak for silver. And after that, the markets cooled down, the physical markets cooled down, and that was the end of it. So when I hear these bullish news, I don't like it. Well, yeah.
But then there's also the fact that for the last 5 years, we've had a deficit in the production of silver versus the actual demand, right? Supply and demand. So there's something to the fact that if the physical markets are short and need to replenish, and they start buying from delivering their contracts from the LBMA and the COMEX, yet we're not producing enough to replace that. It's 5 years in a row. It's the longest it's ever been a deficit. I mean, that has to play into the pricing at some point.
Yes. But the question is, how much of that has already been front run by the market participants and priced in? The run up we had from $25 to 120, maybe a whole bunch of that's already been priced in. Maybe there's going to be more to be priced in later on. Like, I'm trying to be stupid here. All I have to do is just look at the chart, and who cares about all that? I know it's not fun because people want to talk about that stuff, but you got to remember the market is forward looking. I remember the first day Yahoo posted positive earnings or profit per share. That was the exact top back in 2000. It was, because the markets, the earnings per share are terrible. The company's terrible, but the market's forward looking for future stuff. And when they hit that, then that was it. It was the end of it, right? So
yeah,
you got to be careful. Like silver, the time to buy was whatever. It broke out back in July of 2020 when nobody was talking about it as much. Even the breakout in 2023, and people, that was the time, guys. And now it's like it's peak euphoria that needs to cool down. But again, I'm not being bearish long term, because we know, I showed you, everybody saw that long term chart there. We've seen nothing yet, right? We're going to get some crazy numbers later on, but right now in everybody's daily life, there's damage, and there's too much bullish news that needs to disappear. We have to start. We have to start hearing about. There's too much silver, a new discovery. Like, we need to start hearing crazy bearish news, and then I'm going to get bullish. The chart's probably going to start breaking out when we start hearing that.
Right, because when everybody's buying is when you want to sell. When everybody's selling is when you want to buy.
Well, maybe not exactly like that, but
right.
You want it to be quiet for a long period of time, like oil did. Now it's already breaking out. You want it to be quiet for multiple years. That's where the opportunities are born or forged. Multi-year consolidations. Silver, there is no multi-year consolidation. It's over. We've consumed that multi-year consolidation. It's been consumed. So now the only thing we have left in silver is an uptrend, which is great. There's momentum. It's an uptrend, but there's no entry point at all. It's like, if you didn't buy that breakout back then and you're not a stacker, go play something else. Don't buy silver. If you're not a stacker and you didn't buy that original breakout in 2024 or the one in 2020, you'd be an idiot to jump in now, even if the price still goes up. Because I'm not saying the price won't go up, but I'm saying right now, you could buy now, but now it could drop hard. You'll get triggered out. There's risks now, and there's opportunity costs, because now it could consolidate for a year, 2 years. Like, I don't want people to jump in when it's not clear, the roadmap. So I know I get heat every time it's like, sometimes I go into interviews, Daniel, I say, Patrick, don't say that. You're going to upset people. Don't do it. And it's too strong.
I want people to hear every side of the story. I mean, we have mostly fundamentalists come in, right? They understand what's going on in the markets from a fundamental level, right? Geopolitical, the actual, mining industry and everything. I like bringing in somebody from the TA perspective that is ignoring all that. They're just kind of ignoring that and just looking at the charts and what's happening because the charts are telling you, well, it's the hopes and fears of people, like what is it, greed and fear in the emotions into the markets, right? But there's also other factors, but that's what the stock market is. It's psychology, right? That's why you look for trends and psychological tops and psychological bottoms. It's people trading. That's all the stocks are, and you're trying to predict, what's going to happen. And there's obviously more than just people. There's now algorithms and everything that kind of skew things, but and big players and manipulators, but ultimately, I mean, that's what the charts are. But where can people learn more and get some insider information about what's going on with the charts?
Goodness gracious! Well, of course, on X, BadCharts1, all the free stuff, it's all there. It's crazy, but it's not very nuanced, But NorthstarBadCharts.com, guys, get everything there. We created a special discount code for all your viewers. If they type in sound money, when they check out there, they'll get a 50% discount. And that's where, it is there. It's like, go check, guys, on Google review, Trustpilot. It's like, I'll let our members talk for themselves there, the value we give out there. But, we can't, on Twitter, it's fun, you could put big picture roadmaps, but if you want, nuanced commentary and interact with Kevin Wadsworth or myself and get details on silver, the miners and all that stuff, it's behind the paywall, unfortunately, guys. It's like, capitalism. We're too occupied, so we had to do something there.
Yeah, absolutely. Well, Patrick, thank you for coming on. We'll definitely have you on again. Probably do gold next time because we didn't even talk about gold today. And you have a great weekend, and we'll catch you soon.
Thanks, Daniel. Always an honor to talk to you.
Likewise. All right, guys, and there you have it. That is our episode with Patrick Karim, technical analyst. We just saw what he's seeing in the chart, short term, kind of doom and gloom short term, but positive long term. So if you enjoy what we're doing at Citizens for Sound Money, we're going to get into our lobbying in the future. Lots going on around the country, but if you want to support our organization, go to citizensforsoundmoney.org, become a Pioneer member. It's $25 a year or $100 a year. If you do 100, you get a half ounce of digital silver. And if you want to join through YouTube, once we have about 25 members, we'll start having private one-on-ones with our members, with myself, our director of operations, and other guests. So guys, thank you so much for coming. Make sure you hit that like button, subscribe, and you guys have a great weekend. God bless.
Thank you.